In the bustling year of 1913, something new was born in America, the Federal Reserve. It was created to bring order to a chaotic banking system. Imagine a time when banks frequently collapsed and people lost their savings overnight. This was the reality before the Fed. The money supply was inflexible, unable to adapt to the changing needs of the economy. This led to widespread panic and bank runs, further destabilizing the system. The Federal Reserve Act, signed into law by President Woodrow Wilson, aimed to address these issues. It established a central banking system for the United States, a concept that had been debated for decades. This system was designed to provide the elasticity and stability that the American financial system desperately lacked. The creation of the Federal Reserve marked a significant shift in American economic history. It represented a move away from a decentralized, often chaotic banking system towards a more centralized and regulated one. This shift was not without its critics. Some argued that it gave the government too much control over the money supply and could lead to inflation. Others worried about the influence of private banks in the new system. While it is technically owned by private banks, the Fed is not a typical corporation, and surprisingly, even though it is a private corporation, the Federal Reserve is exempt from all federal, state, county, and local taxes. What? Member banks are required to purchase stock in their regional Federal Reserve Bank. These shares cannot be sold or traded like regular stock and do not grant the banks any direct control over the Fed's operations. This unusual structure reflects the dual nature of the Federal Reserve. The Federal Reserve operates under a congressional mandate intended to promote economic stability and growth. Its primary responsibility is to the American people, not to private interests. The FOMC, the acronym for Federal Open Market Committee, is comprised 12 members, including the 7 members of the Board of Governors, who are appointed by the President and confirmed by the Senate. The remaining 5 FOMC seats are filled by presidents of the regional Federal Reserve Banks, only one of whom, the president of the Federal Reserve Bank of New York, is a permanent member. The other 4 seats rotate among the remaining Reserve Bank presidents. This structure is meant to ensure that the Fed's decisions are made with input from various regions and economic perspectives. The Federal Reserve's independence is crucial to its ability to make objective decisions in the best interest of the nation's economy. It operates independently of the political process, free from the pressure of short-term political considerations. The Great Depression, which began in 1929, was a defining moment for the Federal Reserve. It exposed the limitations of the newly created central bank and led to significant changes in its structure and powers. The Fed's response to the crisis is still debated today, with some economists arguing that its inaction exacerbated the economic downturn. The Fed's failure to adequately respond to the crisis stemmed from a combination of factors. These included a lack of understanding of the severity of the economic downturn, a fear of inflation, and an adherence to the gold standard. As the Depression deepened, banks began to fail at an alarming rate. The Great Depression highlighted the need for a more proactive and powerful central bank. It led to the passage of the Banking Act of 1935, which centralized more power in the Board of Governors and gave the Fed more tools to manage the money supply and influence interest rates. Section 5, A Time of War, World War II and its Aftermath. World War II brought new challenges and responsibilities to the Federal Reserve. The Fed played a crucial role in financing the war effort, keeping interest rates low to facilitate government borrowing. Despite the challenges of wartime finance, the Fed emerged from the war with a strengthened reputation. It had successfully managed the nation's monetary system during a period of unprecedented economic and social upheaval. The post-war period brought new challenges, including a surge in consumer demand and rising inflation. The Fed faced the delicate task of balancing its wartime commitment to low interest rates with the need to control inflation. This tension culminated in the Treasury-Fed Accord of 1951, which formally granted the Fed independence in setting monetary policy. Section 6. Navigating the Storm, the Great Inflation. The 1970s brought a new economic challenge, stagflation. This unusual combination of stagnant economic growth and high inflation baffled economists and policymakers alike. The Fed found itself caught between a rock and a hard place, Trying to control inflation by raising interest rates risked deepening the recession. Lowering rates to stimulate the economy could further fuel inflation. The experience of the Great Inflation taught the Fed a valuable lesson about the importance of maintaining its commitment to price stability. It also highlighted the limitations of monetary policy in addressing supply-side shocks, such as the oil crises of the 1970s. Section 7. A period of calm, the Great Moderation. The 1980s ushered in an era of relative economic stability known as the Great Moderation. This period, which lasted for over 2 decades, was characterized by low and stable inflation, moderate economic growth, and infrequent recessions. The Fed, under the leadership of Chairman Paul Volcker and later Alan Greenspan, played a key role in this period of economic stability. Volcker's decisive actions in the early 1980s, raising interest rates to combat inflation even in the face of a severe recession, helped break the back of the inflationary spiral. The Great Moderation was not without its challenges. The Fed faced several economic shocks during this period, including the stock market crash of 1987 and the dot-com bubble of the late 1990s. Section 8. Facing the Abyss, the 2008 Financial Crisis. The 2008 financial crisis was the most severe economic downturn since the Great Depression. It originated in the U.S. housing market, where a combination of factors, including loose lending standards and lax regulation, led to a bubble in housing prices. When the bubble burst, it triggered a cascade of financial failures that threatened to bring down the global financial system. The Fed responded to the crisis with unprecedented force and speed. It slashed interest rates to near zero, injected trillions of dollars of liquidity into the financial system, and launched a series of emergency lending programs to support struggling banks and other financial institutions. These actions, while controversial, are widely credited with preventing a complete financial meltdown. The 2008 financial crisis had a profound impact on the Federal Reserve, forcing it to rethink its role in the financial system and its approach to monetary policy. Section 9. A global challenge, the COVID-19 pandemic. The COVID-19 pandemic, which began in early 2020, presented the Federal Reserve with yet another unprecedented challenge. The pandemic and the ensuing lockdowns triggered a sharp and sudden economic contraction. The Fed responded to the pandemic with the same speed and force it had displayed during the 2008 financial crisis. It slashed interest rates to near zero, injected trillions of dollars into the financial system through asset purchases, and launched a suite of new lending programs to support businesses, households, and state and local governments. The Fed's actions, coordinated with fiscal stimulus measures, helped to cushion the economic blow from the pandemic and facilitated a faster-than-expected economic recovery. Section 10. The Fed's Toolkit, Ensuring Economic Stability. Throughout its history, the Federal Reserve has developed a range of tools to manage the economy and maintain economic stability. These tools can be broadly categorized into 3 categories: monetary policy, financial regulation, and financial services. Monetary policy is the process by which the Fed influences the supply and cost of credit in the economy. The Fed's primary monetary policy tools are the federal funds rate, the discount rate, and reserve requirements. The federal funds rate is the interest rate that banks charge each other for overnight loans. The discount rate is the interest rate at which commercial banks can borrow money directly from the Fed. Financial regulation refers to the rules and regulations that govern the behavior of financial institutions. The Fed plays a key role in supervising and regulating banks and other financial institutions to ensure the safety and soundness of the financial system. Section 11. The Balancing Act continues. The Federal Reserve has played a pivotal role in shaping the American economy for over a century. Its history is a testament to the evolving nature of central banking and the enduring challenges of maintaining economic stability. The Fed has weathered numerous crises, from the Great Depression to the COVID-19 pandemic, adapting its strategies and tools to meet the demands of a constantly changing economic landscape. The Federal Reserve's unique structure, blending public purpose with private sector participation, has been a source of both strength and controversy. As the Fed navigates the complexities of the 21st century economy, it will need to continue to adapt and evolve, striking a delicate balance between its mandates of price stability, full employment, and financial stability.